Is it possible to go from knowing absolutely nothing about day trading and getting your first payout in 30 days? My name is KJ, also known as KJ Trades. I've been trading for 3.5 years and I got my first payout a year and a month into trading. Then I fell into a deep hole of pride, which set everything back to then becoming profitable a year and a half into my trading. In the past 4 months, I've been getting around 5-figure months consistently to now copy trading 7 accounts going on 10 by hopefully next week. In this video, we're gonna find out if I can get my best friend Luca his first payout in 30 days, going from knowing absolutely nothing about trading. And I'm gonna be teaching him the necessary confluences, and at the end of that, we're gonna put him to the test to see if he can take a trade. Stick around to the end of this video to find out how he does. What is going on, everybody? I hope you guys are having an amazing day. As I said, my boy here knows absolutely nothing. Like, bro, what are you even looking at right now, dude? Do you understand what you're looking at?
No.
Nothing, bro. And so I became profitable a year and a half into my trading. And one of the hardest things that every beginner day trader goes through is not even, first off, they don't even know what they're looking at. Number two, they gotta rewire their brain, bro. They be coming on here thinking, like, oh, it's a get rich quick scheme. They think they're gonna become profitable in 10 days.
It is, though.
That's what he thinks right now, bro.
I'm telling y'all, this is easy.
I had sleepless nights, arguments with my parents, no idea what I was doing, bro. Blew thousands and thousands of dollars off in evals because I thought my mental was just, it was so cooked, bro. It was so fried. I just wanted to make money as quick as I can. So we're gonna make sure bro does everything correctly to the point where he gets his first payout. So with that being said, let's get straight into it, man. So the first thing that you wanna do, this right here is called trading view. So why does this matter? Because as you can see, these are candlesticks, bro. You've seen this on TikTok, you've seen these before. All this is, bro, is telling you where exactly is price going. So this is how you chart your trades. This is how you see where they're going. This is where you can either enter your trades right here, click buy and sell. If you want a paper trade or connect it to a broker called Trade when you use prop firms to make money. I know there's all buzzwords right now, but so with that, I'm gonna be showing you what are you looking for. So we can start off by changing our chart colors, bro. So I want you to click the mouse, go into settings. So right click anywhere on the chart, click settings down there. First things first, bro. Go to canvas. You see background right there? Change that to gradient. Boom, beautiful, bro. Go to symbols on the top left. And now change all of that, change the green to white. It's gonna make it look very pretty, bro. I'm telling you right now. Boom, and now the red to black. Boom. You can make it a little bit lighter, low key. Beautiful, bro. Chart's looking a lot better. So right now, you see on the right side, all this stuff, bro. I want you to drag this. Boom, nice. Now, first things first, bro, trading is an algorithm. This is a hard high-income skill, bro. I've been trading since high school sophomore year. You remember that, bro. And so this is gonna take some time. So you gotta understand what you're even looking at, bro. And so to do that, I want you to go on the left side. You see that left side right there? You see that ray, that line up there? Click the little arrow to the right of that. I want you to star that. That's called the trend line. So that's how you're gonna use to identify things like confluences. And what confluence is, that's a fancy word, but all that means is like, it's like pretty much your toolbox. So the more toolboxes you have in the correct order, the better you're gonna be at when you're looking at the charts.
What do you mean toolbox?
So long story short, bro, what confluences are, it's like an arsenal, right? So let's say a zombie
I get what you
apocalypse.
mean. It's what I can use.
It's what you can use to look.
To help me get a better trade.
That's all it is, bro. So from there, go to the pencil. So I want you to start rectangle at the bottom, right there. Start rectangle, and then go up the top left. There's a long position right there. A little bit lower, right there. Go to the arrow. Now start long position and short position. That's how you're gonna identify. You've seen this before. That's how you buy and sell. That's the tool that it looks like. So from there, bro, that's honestly pretty much all you need for the tools. And now these tools are gonna help you find your bias for the day, which bias, long story short, all bias means is where you think price is gonna go. So bullish or bearish, meaning up or down. So if you think price is gonna go up, your bias is bullish. If you think price is gonna go down, your bias is bearish. So from there, how do you even look at that? Well, you gotta look at the higher time frames. So you see up there where it says 15M, click that. Star that, 5 minute, star that, 3 minute, and 1, right up there. So go down to the daily time frame and I want you to star that.
1 day?
Yep, 1 day. Then go to the 4-hour time frame and star that. Then go to the 1-hour time frame and star that. 15 minute. So that's pretty much it, bro. That's what you're gonna use to identify everything. So from there, I want you to click 1D on the keyboard. It's gonna take you to the daily time frame. So 1D and then enter. Now that you're on the daily time frame, bro, what do you think you're even looking at right now, bro?
It's the price.
That is the price. That's price action.
Wait, is this one? Am I looking at a single stock?
So right now you're looking at NASDAQ. So there's Forex, futures, stocks, options, and crypto. So we're trading the futures market, and in specific, we're trading NASDAQ. And so all you're looking at right now, since you see that we're on the daily time frame, each candle, these are called candlesticks, by the way, each candle is a day. So why does this matter? Well, it matters because for you to identify where price wants to go, you gotta look at the higher time frames because higher time frames equals higher power. The higher time frame you go, the better it'll be to identify where you think price wants to go. So
that actually makes sense.
Bet, beautiful, bro. So right now, I'm gonna add this as well, just so I can type this down. Higher time frame equals higher power. So with that, we're gonna jumpstart this, bro, because I'm trying to get you profitable. I'm trying to get you.
Bro, it's only gonna take a couple minutes.
That's what you think, bro. I'm gonna jumpstart this, bro. So we're gonna try to get you your first payout, bro. So the first confluence that we're gonna go over is liquidity? I'm sure you've heard of liquidity before, maybe. No?
I heard the word like chemistry class.
All right, bro. So long story short, bro, the people who move the markets, this is essentially the way that I look at it. Other traders look at it the same way. So the way that the market moves is these market makers, right? These banks that are trading with millions and
Jews,
billions
right?
of dollars.
I saw, what's his name, the bodybuilder, Togi.
The Jewish fake out, bro. That's what we're about to go over right now, straight up. So you look at the higher time frames, right? This is what's gonna tell you about liquidity. So for liquidity, bro, all it is that these central banks, since they're trading with millions and billions of dollars, their orders can't be filled with ours because we're only trading with $1,000. Most of these people are trading with prop firms, so it's not even gonna work like that. So to start off, bro, all it is this. So let's say you're starting here, right? We'll go to bar replay mode. Actually, we can't because we don't even have a thing. All right, so let's say that you want to take a short, right? Meaning you want to take a sell right here. Boom, beautiful. You're expecting price to go down, right? Into this here. Oh, we can target this gap right there. So let's say you want to target that low right there, all right? What happens? Boom, price goes down. Your stop loss is at this high because your stop loss is going to be at a high. Let's say price goes down. Boom, it's going down. Oh, shoot, look at that. Price hit your stop loss. That took you out. So why did that take you out? Because for these central banks, these banks that are trading with millions of dollars, they have to take you out of your position first for their entries to get filled. Does that make sense?
Yeah, they're trying to screw you over.
Long story short, they're trying to screw you over. So how can you use that to your position? You want to trade with them. You don't want to trade against them. So what you wait for is you want to wait for these things called liquidity sweeps. So let's look at the wick of the candle. You see the wick right here? If I was to draw a line from the high of that wick, matter of fact, I'll zoom in here for you. If I was to draw a line from the high of this wick right there and I drag it out, you see how the wick is covering this high right there? That is called a liquidity sweep. And so since we're looking at a liquidity sweep from the hour time frame, higher time frame equals higher power. So a liquidity sweep on the higher time frame is way more likely to play out than a liquidity sweep on the 1 minute or 5 minute.
But why is this important?
So it's important because you can use this to your tool. So now that you saw that the central banks took out pretty much all the other retail traders, the stupid traders, price would like to go down, right? So now you can enter the position, boom. Now you can enter your stop loss at the high, and now you can continue your target, and look, boom, you make money.
So what I'm looking for is I choose a wick, the top of a single wick,
right?
And then if I see another one go higher, then I enter?
Not necessarily, but that's a piece of the puzzle. So that's one confluence, all right? So right now what I want you to do is I want you to spot multiple liquidity sweeps. So that's what we're going to work on right now.
Easy.
We'll see. So buy side liquidity and sell side liquidity. That's something that you need to know. So what's buy side liquidity? What's sell side liquidity? Buy side liquidity is just highs at the top and highs at the low. So boom, buy side liquidity up here, buy side liquidity right down there. We have sell side liquidity right here because it's at the lows. Sell side liquidity right here.
So it can be up or down.
Up, buy side is up here, sell side is down here. So I want you to mark out 2 buy side liquidities and 2 sell side liquidities. We'll go here. So go for it. You use the line tool up there.
All right, I see one right here.
A liquidity sweep? So for liquidity sweep, that'd be like an internal sweep. What I would like for you to draw, you can draw it up here. So you see how if you were to do it at the highest high right there, you see this is a higher high. We have higher highs, higher low, or lower low right here. So you want to mark out from this high and you drag it out all the way to the right. So you see how this wick is engulfing this high right there? That is a beautiful price goes straight down. So think of it like a trampoline, all right? So if we have a liquidity sweep, let's use this for an example. All right, let's say we have a liquidity sweep. It looks something like this.
Okay, I get the trampoline.
Yeah.
It's like this guy jumps, he jumps up.
And then he's gonna fall down. He jumps here, he goes down. He goes even higher, he takes out price, and then he goes even lower. So that's something that you can expect with liquidity sweeps. So we have one up there, and we also have one down here. Look at this. We have this low right here, and then if you drag a line all the way to the right, look at this wick. It's engulfing it at the low. Okay. So then it goes up even higher. It's the anti-trampoline. Think of it that way. So, go for it, bro. Try to give me an example.
Wait, okay, I do it. Oh wait, I'm zooming in and out. How do I go left and right?
So you can drag this, move it to the right, and move that there.
I'm trying to find one.
All right, so go for it, bro. Try to find one.
I see one.
Use the tool right there. So click that button.
Oh wait, no, this one doesn't really work, right?
No, not really. Here? It's like no. Look at the external. So external is the ones at the high, low, low. Don't look at these ones right there.
Right here.
Mark it out.
All right.
Matter of fact, we can go to the 15 minute right here to look at this. So now let's find it. Where were we at? Look.
I see one as well.
Here. I just put the erase tool, so now you can just click wherever.
I spotted one right here. Boom.
Not gonna lie, bro. That is not one.
No?
Well,
How?
you're looking at it correct, right? Look, this is engulfing that, but I want you to look at the external right now. So look at the highest highs, and then for the internal. But an external liquidity sweep would be something like this. Boom. Look at this one.
Oh.
It's at the low. All
Alright,
right, go for it.
Nah, that one don't work.
I think it does.
You think?
I know so. Look to the left.
What?
Oh, click the little button.
I'm looking at this.
To what?
Here.
Oh, that's not one. But look at the one to the left. Look at this to that. You see that?
Oh, okay, yeah.
Boom. And then hold shift. If you hold shift, it makes it straight. Look at that. So then you can just drag it to the right.
So that would be one.
Well, drag it, make it straight. So click that. Yep, boom. And then move it all the way to the right. You want to make sure it covers this one. One more. Boom, beautiful. First liquidity seed, bro. So that's buy side liquidity. And so why did this matter? Because you want to make sure you stack up your confluences. So this right here is one confluence, right? So since we're day traders, our job is to take small trades in a lower time frame. So this is a liquidity seed at the 5-minute time frame. So from there, we got to scale into the 1-minute time frame and then add up a confluence so we can enter on the 1 minute. But since higher time frame equals higher power, we can use this higher time frame fair value gap, higher time frame than the 1 minute fair value gap, to give us a narrative, to give us a continuation model to target our overall drawn liquidity. So this is one confluence. This is liquidity sweep. From there, I want you to mark out another one.
I think I spotted one.
Here, make sure to click that tool again.
Right here. From here to here.
Boom, beautiful. That's one. So you got two. So this is one right here. Boom. Why is it one? Because this wick right here engulfs this one down there. And then we start to go up higher. Beautiful. So now let's look for another one.
All right.
This is a clear one right here.
Oh, let's see. We have this right here.
Dang, bro. 15
it.
minutes in and bro's already spawning liquidity seeds, bro. All right, one at the highs. All right, let's look at another one at the lows, south side.
I see one.
Go for it.
It could be this, right? From here. Oh, wait. From here to here.
Beautiful,
And
bro.
it goes up.
Dang, bro. All right. So he's got liquidity down, bro.
Yeah.
So this is liquidity sweeps. So tell me, why does this matter? Why are liquidity sweeps important?
Because it kind of hints where the candles are going to go next.
It's an indication that we could potentially go up there.
Exactly.
So another thing in trading, bro, no strategy is 100%. So strategies are always,
actually?
you're going to lose
Okay.
trades. You're going to lose trades. But how do you get past that? You got to protect capital. You got to realize, number one, I got to rewire my brain to the point where every single time I hop onto the charts, you're observing. You're not forcing setups. You're waiting to see your setup present itself. And that's why right here, what I have is I have my trading journal. And this goes over pretty much everything I want to see. This is my checklist right here. So I have two sections of the checklist, which I can show you guys. The first section is going over, are market conditions clean? Because why is that important? Because even if you see your setup present itself, meaning you see all your confluences, you see liquidity, you see all the other ones, price can still not respect your trade if market conditions aren't good.
What do you mean by clean?
That's a beautiful question. So what looks cleaner to you? This right here, you see how this is choppy? It looks like a barcode. That or this right here, this long. This is clean. Why? Because we're moving straight up. And this right here is called choppy.
So it would be like how extreme it is?
Pretty much.
Whether it goes up or down?
Yeah, pretty much. So that's what volatility is. Volatility is important in the markets because it accelerates where the market wants to go. The market knows where it wants to go, but what this does is it speeds up that process. So right here, it's ugly, right? It's choppy.
Yeah.
Boom. Right here, what is it? It's clean.
Wait, so what would you call the unclean? You say it's dirty?
Choppy.
Oh,
It's just choppy and then clean price action. So beautiful, bro. So now we can go back to the daily time frame. So now you have liquidity receipts, bro. I want you to spot it on the daily time frame.
All right.
So give me two more examples just to make sure you got it down.
All right, I'd assume this is one right here, and then it goes up after.
Look at that. It is one. This is a liquidity sweep on the daily time frame. But look at, there's another one right here. You see that? Boom. From right here to right there. So that's a cleaner one. There's another one up here somewhere.
The highs. Wait, can it work in reverse?
No, no, no.
Right here. That's already there.
That's another one right there.
One more right here.
There's one right there. Beautiful, bro. You got liquidity sweep down. So perfect. Now we can work on fair value gaps. So the reason why we're looking at liquidity sweeps, then fair value gaps, and then we're going to cover break of structure and then SMT. The reason why is because the more confluences you have, the better. There's an extreme on both ends. There's an extreme where you have little confluences, so your strategy just isn't good. And there's also an extreme where you have analysis paralysis, which is pretty much like you're looking at too much stuff that contradicts each other, so you get pretty much confused. So first thing that we're getting.
Wait, so it would be better to know less?
You got to keep it simple. It's better to know, it's better to master 3 than to know a little bit about 50.
Okay.
So liquidity is the first one. Then FVG. FVG stands for fair value gaps. And now fair value gaps, what that is, it's a 3 consecutive candle pattern. So think of it like this. Boom. Matter of fact, I'm gonna change this to red, or we'll change this to green. Boom. So this right here is a fair value gap. Now, why is it a fair value gap? Because a fair value gap, what it is, it's an imbalance in the market. So if it's an imbalance, what price wants to do is rebalance it. So what does that even look like? I know I just said some crazy words right now. So a fair value gap is a 3 consecutive candle pattern. So 1, 2, 3. You see how these wicks, if I was to draw a line from this wick, from the first one, all the way to the right, matter of fact, I'll make this a different color just so it stands out. If I was to draw a line from that wick and the low of the third wick, you see how there's a gap in the middle? Look at this. There's a gap. The wicks aren't overlapping. That right there is the imbalance. So think of this as well as a trampoline. So let's say price is right here, right? So boom, we go down, tap into that gap, and then we start to trill up higher. So you see how it bounces into that gap and then we start respecting it and go even higher? That is the fair value gap. But what happens if the wicks are like this? If I was to draw a line from it, look, boom, a line there, and then boom, a line there. You see how they cross each other? That is not a fair value gap. So a fair value gap is when there's a gap in the middle of the wicks. So it'd be like this, boom. Look, now if I was to draw a line, boom. And the tool that people use for this is the rectangle tool. So it would be like this. You draw a box from there all the way here. And then I can make this box yellow. Boom. That is a fair value gap. And then you want price, as I said earlier, to tap into this, boom, respect it, and go even higher. Sometimes it's gonna get disrespected. But how can you tell if a fair value gap is gonna get respected or disrespected? By aligning it with other confluences. So that's why it matters. Because if you stack up confluences, it'll tell you, is this gonna play out or is it not?
Wait, quick question. Does a liquidity sweep, does it apply if it's not consecutive?
A liquidity sweep or fair value gap?
Liquidity sweep. Instead of it being with this wick, it's with this one. Would it work?
No.
It's only when they're right next to each other.
Always. Yep. Or it can be something like this. Matter of fact, this can also be a liquidity sweep like this. Boom. Let's say price is going down like this, whatever. And then we start to go up. Boom. You see how if I was to draw the line from this, the wicks are covering, it's overlapping. That's a liquidity sweep.
Oh, so only applies if it's extreme.
Not necessarily, but this is just a clear example of it. So now let's work on spotting fair value gaps. So let's go to the 1 hour time frame. And then we're gonna find both, all right? So same thing applies with a bearish, but right now we can look at a bullish. So look, 1, 2, 3. Look, if I was to draw a box from here to here, from the high of the first wick to the bottom of the third wick, there's a gap in the middle. You see that? Boom. And price taps into it. We have a bullish candle next. So that's a bullish fair value gap right here. So what do you expect from a bullish fair value gap? You expect price to come down, tap into it, and then go a little bit higher. For a bearish fair value gap, it's like this. Look, 1, 2, and 3. You want to see price tap into it and then go down. So right here, the wick taps into it, and then we start to go down. You see that?
Yeah.
So this is a bearish fair value gap. Why? Because there's a gap in the middle. Look at that. Boom. But it's weird, right? Because we have a bullish candle up here, and then we have a bullish candle. So how can you tell if it's a bullish or bearish? You look at the middle candle. If the middle candle is bearish, it's a bearish fair value gap. But if the middle candle is bullish, meaning it's a green, an up candle, then it's a bullish candle. And it's a bullish fair value gap.
So it all depends on the second candle, and it'll determine whether it goes up or down.
If it's a bullish or bearish fair value gap. And so with that, let's spot how does a fair value gap get respected or not. So let's use this bullish fair value gap for an example. Let's say I draw the high. So I'm drawing the box from the high of the first wick to the bottom of the third right here. Look, there's a bearish candle, but look at the middle candle. It's a bullish. It's going up. You see how right here, this doesn't respect it. We tap into it, but then we keep going down. Why did that happen? Because the body of this candle closed inside of that fair value gap.
Oh, so
it can only be the wick that closes inside of that fair value gap. So let's look at a good example right here. Literally this bearish fair value gap right here. You see if I was gonna draw a line from here, the rectangle, look at the wick. The wick closes inside of it, but then the body closes under it. So it's respecting it. Does that make sense? So price, what's supposed to do? Boom, we're supposed to tap into it and then go down. Same thing for this. But in this case, it got disrespected. So how can you know which fair value is going to get respected or disrespected? You add up the liquidity sweeps. You look at the higher time frames. That's what gives you power. Again, higher time frame equals higher power. So if you have a higher time frame fair value gap on the 1 hour time frame instead of the 1 minute, it's going to have more probability that it's going to play out.
Is it easier to trade on the lower time frames?
It is, only if you use the higher time frames to support your entries. And so what does that look like? That looks like going on the daily time frame every single morning before market open and looking for liquidity sweeps, looking for fair value gaps, and looking for all these other things. If you look for that on the daily, then you go to the 4 hour time frame, and then you go to the 1 hour time frame, that'll give you your daily bias, which is like, do I think price is gonna go up or down for the day?
That's a liquidity sweep, right?
It is. Look, and as you can see, look, liquidity sweep right up here, and then price goes down.
Yeah.
You see that? And then look at this one right here. Look, liquidity sweep right here. Boom. Matter of fact, look, liquidity sweep right there, and then price goes up. So that's why you start off on the daily time frame, because higher time frame equals higher power. So you start off on the daily time frame, you look for bullish, you look for liquidity sweeps, you look for fair value gaps, you look at things like that, and that'll tell you wherever price wants to go for the day. Does that make sense?
Yeah.
Beautiful. So from there, we'll start off on the daily time frame. Boom. Let's look at what price is doing right now. Matter of fact, I'm gonna give you, so now I'm gonna show you one more confluence. So we're gonna get 3 down in one day, which is insane. Right. So this confluence is gonna help you identify more where you think price is gonna go, and it helps you out with that. So you see how a liquidity sweep is like this? It's pretty much, let's say this is a wick right here, boom. Oh shoot, let's look at it like this, boom. So you see how the high of this wick gets swept right there? Yeah. What happens if the body of the candle closes above instead of the wick? What happens there? It gets disrespected, right? The liquidity gets disrespected. That's an indication that price is gonna go up. So what is that doing? That's breaking structure to the upside. So what this next confluence is called, it's called break of structure. So price is breaking structure to the upside or the downside. Let's look at an example. So let's use this one right here. You see how this one right here, boom, liquidity sweep, right? So now since price swept liquidity, you can anticipate that price wants to go up. So look, we can target this high for the next day though. Look at this body engulfing the wick. That's price breaking structure to the upside. This right here is a bearish candle, so we should go down, right? This right here is price breaking structure to the upside. So what can you anticipate then? You can anticipate price to take out that liquidity sweep up, that wick up there. And look what price does. We sweep it. You see that? We sweep it. So then we can anticipate price to target this low. But then look, oh shoot, we broke structure. We closed below that low. So now we can anticipate price to do what? To come up here or to come down here? If we broke structure to the downside.
If it breaks the structure, it's gonna go to one of the ends.
So which one? If it sweeps liquidity, if this down here was a liquidity sweep, we would want to go up here. But since we broke structure, where would we want to go? Here or here?
Probably
down. We would want to go here. So that's how you can find your bias on the daily time frame. You start off, and matter of fact, I'm going to show you right now. I'm going to give you a bit of an example. So let's use this one right here. So let's say, ignore all this.
Oh, wait,
imagine.
And a quick little call. All right, keep going.
All right. So imagine this, all right? Ignore all that right there. Imagine you don't see these candles from here to there. Let's just look at this high right here. What is this right here?
Liquidity sweep.
So what can you expect price to do?
Go down.
So we can try for the next day, we can target this low right here, this wick. After sweeping up higher, it's gonna go low. So we want to see price take that out. But look what happens.
It broke structure.
It breaks structure. So then we can anticipate price to do what?
Go up.
No, go down. It breaks structure to the downside. Look, this candle is engulfing that low. If it was sweeping liquidity, we would want price to go up.
Oh, so basically if it's not liquidity sweep, it's gonna do the opposite.
Pretty much. If it's breaking structure, it's gonna do the opposite. So as soon as we see that, we can target this low because we broke structure. It's gonna go down, and then what happens here? Look.
Breaks. Oh, is that sweep?
It's a sweep. So we can anticipate price to go up. So that's how you find your daily bias, at least on the daily time frame. That's how you find your bias on the daily time frame. So from there, you can do that. That's how you find your bias on the daily time frame. Then from there, you can go down to the 4-hour time frame. You do the exact same. Not necessarily like what we just did looking at the previous candle, but now you look at a bigger picture. So now you can look at stuff like this. Oh shoot, liquidity sweep here at the low. You see that? So we can anticipate price to maybe go up to this high.
I thought you said it can't skip one.
What do you mean?
The liquidity sweep.
Oh no, it can. It doesn't have to be right next to each other.
Oh.
It can skip anything as long as the wick is being engulfed by another wick. But look at this bearish fair value gap right here. You see that? Price hasn't tapped into it yet. So look, we sweep liquidity, and there's a bearish fair value gap up there, which we should anticipate price to, it would be like that, right? We tap into it and then we start going lower because it's a bearish. Exactly. So what can we anticipate? We can anticipate price to go up into that. So this up here could be a potential target, this area right there, because we know that fair value gaps, once they get respected, they usually go back down for a bearish fair value gap. But look, we swept lows right there. And now, because of that, price is right here. You can tell because there's a dotted line, and look at this bold right there. You see that? So price is right there. What we can expect is something like this. Boom. Maybe price to come up here. And then that's how we can take a trade targeting that fair value gap.
So you could take 2 trades here, right? You can take one down here for it to go up, or one at the top for it to go down.
Pretty much, at least for the confluences that we're gonna stack everything up, but this is it. So now fair value gaps, liquidity sweeps, break of structure. So now what's next is adding it all into one strategy, okay? And so what we're gonna do is that on the next video, we're gonna show you exactly what it looks like to go over my personal strategy that I've been trading for 3 years, which is called the MMXM. It's called the market maker models. And so I've collected data on that for 3 years. I've made 5+ figures a month off of that strategy. So I'm gonna show you everything about it, the ins and outs to get you to your first payout, bro. But this is crazy, dude. In 30 minutes, you understand liquidity sweep, fair value gap, and breakup structure. So maybe we'll see if you beat the challenge, bro. 30 days.
I think I can.
But just remember, bro, this is a hard high income skill. So this is gonna get difficult, bro. You gotta understand.
No, I can see how it gets difficult.
It gets difficult, bro, because right now you're looking at the picture. You're looking at it already played out. When you're trading at 9:30 a.m., the candles aren't gonna be there. It's gonna start forming. So that's when you realize, oh shoot, what's going on here? But that's pretty much it, bro.
Wait, can I try a trade right now?
No, scratch that because you can't. Because market's closed right now.
There's no simulator?
Nah, not really, because you gotta pay for it.
I was gonna say that would be good to see if I can actually do it.
Should we?
You could just
I can sign
go
in on my other account.
on your account, but obviously not actually trade.
Yeah, trade. So right now what we're gonna do, bro, is we're gonna put you to the test. So we're gonna go on to trading view, we're gonna go to bar replay mode, and you're gonna try to take a trade off of only the confluences that you right now. Which honestly, it's not the strategy that I trade, but this will help you. It's enough to potentially take a trade. For my eyes, it'll probably be like a B setup, maybe C plus or something like that. But we're gonna add it up and we're gonna make sure you understand what you're doing.
It's a memory game.
Let me sign in real quick. Sign in. Bro, what?
It's just taking you through the same thing over and over.
I know. Oh, I gotta sign out here.
Sign out.
I gotta sign in on my thing.
Oh, it's with the Keo agency email?
That's an OG, bro.
I still have the email as well.
Oh shoot, wait. What?
Maybe it's like
It might be this one.
exclamation mark at the end or something. That's not good, bro.
Oh shoot. No, I'm chilling. I have it on my phone. I'll just check here. Oh, let me pause. So now we're signed in on my account, bro, and now I'm about to put you to the test, bro. So you're gonna use these tools here. You're gonna take a trade. You use the 1 hour time frame, then scale into the 1 minute time frame, and that's when you look for everything. All right. So let's do it. Let's start right now, bro. So go for it, dude. Tell me what you see.
Wait, it's gonna move?
It will here in a sec. I'll show you when.
Wait, that's over here. All right. So I can look.
Anywhere, bro. Anywhere.
Wait, how do I?
Anywhere.
Oh, it was selected. No.
You can just hold. You can just click the delete button on the keyboard.
I got enable cross. Let's see. Oh, this is what I would have tapped.
That little one right there? Nah, bro. You can, but I wouldn't use that. I would use something like this.
Something. I get it.
A+ setup, bro. You gotta take an A+ setup. You gotta make sure you're super confident with it. I sniped one, bro. I'm just waiting to see when you snipe it.
Break of structure?
That's a break of structure, and look what's under it. Hold on.
All right.
Now don't use the rectangle.
This one? Yeah. But I want to draw the fair value gap.
There's not one there.
No?
Not yet, bro. Or there is one, but I don't think you see it.
No, let's see.
You already started off wrong, bro. I'm not gonna lie. Mark out the liquidity sweep, bro.
Wait, no.
That's a
break of structure. Yeah. So when it breaks structure.
Is that to the upside or to the downside? That's to the upside. So look at the, here, go to the 1 minute, or look at this liquidity sweep right there. So mark that out. Boom. And now scale into the 1 minute time frame. Or use the 5 minute.
It saves like what I was looking at?
It does. Here, there it is. Alright. Alright, so now you scaled into the 5 minute time frame, bro. This is what it's looking like right now, bro. So look, you have a liquidity sweep at the lows, then you have price breaking structure up there. Matter of fact, I would look at this one down here. Look at that breaking structure right there. You see that? Look right there. There's a high, look, I would use this breaking structure right here, bro. Look, there's a wick right there. You drag it a little to the right. The body closes above it. So that's the liquidity sweep and a break of structure right there. So would you enter this trade?
Yeah, I actually would, because I can see what happens in the future.
Let's freaking... No, hold on. Let me redo this. Hold on.
I have future sight.
I saw you do that already. Hold on.
There you go. Now I actually can't see.
All right, bet, bro. So now we're in the 5 minute time frame, bro. You see this liquidity sweep right here. So what are the other confluences that you gotta wait for?
So we got fair value gap and break of structure.
So now let's wait for a break of structure. Or now it's up to you, bro. So let's click this next candle right here. Boom. Is that it?
Let's see. So this goes like that. So it has to go up. So I think that's actually, it's doing what it's supposed to do, I feel like.
But would you enter here?
I would wait one more candle to enter.
Is that a break of structure?
Nah, that's definitely a break.
All right, mark it out, bro.
I use this one?
No, use the ray. That one, the trend line. For break of, hold on, let's redo it.
Like that?
You gotta do it from here. Look at this high. If you mark out a high from here all the way to the right, the body
I was looking at that.
Or you can mark that one too. Boom.
That's the one I was looking at.
Perfect, bro. So you have a liquidity sweep, bro. Break of structure. Now would you enter the trade?
Because when it breaks the structure, what happens when it breaks the structure?
It's an indication that we're gonna come up even higher because we're breaking structure. We're going from bearish right here, bearish candle, to bullish because we closed up above that.
So now it means it's gonna go up?
So now, boom. This is the long position right here. So what could you target? You remember, you want to anticipate liquidity sweeps. So you could anticipate, you can target what? Buy side liquidity, right?
Exactly, yeah.
All right, so mark that out, bro. Let's see. What's the buy side?
So the top, what was this?
So you want to drag this up or down.
But so what's that signal?
So as soon as price, let's say, right, boom, you're into this trade. If price closes above this high, it automatically stops you out. And if price closes below this low, it automatically stops you out. But here, if it closes below this, you'll stop out in a loss. But if price closes above here, it automatically stops you out in profit.
Because I bought here.
Because you bought right here. Yep, right there. So boom. So you want to target engineered liquidity, which is just buy side liquidity. So look at this high right there. Price hasn't swept that. You see that? So you can anticipate a liquidity sweep. So you can target that. So now let's see. We'll click buy. We'll do a limit order right here. Boom, buy. Stop loss right here and take profit up there. All right, bro, this is kind of your first trade, bro. You ready? Let's wait and see. We'll put this here. We'll do this times 5. Yo! Bro, full TV, bro.
It went up so high.
Full TV, bro. So this is a trade with only liquidity sweep and break of structure. So imagine what it would look like once you stack up the confluences, bro. This is gonna be good, bro. So right now, you have fair value gap, liquidity sweep, and break of structure. On the next episode, we're gonna go over SMT divergence, order block, adding that all into one strategy so you can have a system in place to get you your first payout, all right? We're also gonna introduce psychology because psychology is probably the biggest aspect in trading. Trading is probably like 20% strategy, 80% psychology.
Actually?
So you need to fight your own urges. You need to have self-control to the point where you don't take stupid trades, where you wait for a good setup, and you get to that payout, bro. So that's it. Sweet,
I feel like I learned a lot today.
I'm stoked, bro. I'm stoked to get you your first payout, bro, before all these other students. So the goal is to get you a payout before, the record in my Discord server, bro, is 52 days. So it took one of my students 52 days to get his first payout from not knowing what a fair value gap was before we started to now him being in the server getting his first payout in 52 days.
Wait, what do you mean payout? What's a payout?
So a payout, bro. So you're pretty much making money, bro, off these prop firms. And so how it works is that you pay this company, let's say $50. They'll give you a $50,000 demo account.
I remember.
They'll give you a $50,000 demo account. And long story short, you have to take that demo account for $50,000 to $53,000. And once you do that, then you can pass the account without losing $2,000. So if you pass that account, get that to $53,000, you keep everything else that you make after that. Once you follow the rules in the firm and stuff like that. So we're gonna get you that first payout, bro. But with that being said, guys, thank you so much for watching this video. I hope you guys have enjoyed this, and I also learned a lot for the beginners that are watching this video. Make sure,
I know I learned a lot.
So there you go, bro. Make sure y'all to tune into this series. I'm excited. Hopefully we can get bro his first payout in under 30 days. That'd be crazy.
Easily.
I'm gonna make sure bro gets locked in and dialed up. I also have a free Discord. Make sure to click the link in the bio, guys. It's gonna take you there. And man, I hope you have an amazing day. God bless you guys. I'm praying for you. Observe and don't force setups. I promise you get your payout. See you guys.